Good day, it's Mark Whitten here from Portal Asset Management. I thought I'd give all you returnsters a brief macroeconomic update as to what we're seeing developing in South Africa at the moment, given the recent announcement by the government last night of, unfortunately, further lockdowns, as well as the cut in rates yesterday. So first of all, let's look at where we are and the current state of the nation. Unfortunately, South Africa has had quite a disastrous decade since the Zuma regime took control in Polokwane in 2009, and South Africa took a jump to the left, so to speak, in terms of moving. Unfortunately, what of a lost decade. And education has failed successive generations, and due to the lack of education and skills transfer, you've got structurally high unemployment, particularly amongst the youth. And this unemployment is further compounded by lack of investor confidence due to both very much legitimate concerns around the rule of law with radical economic transformation, security of property rights, and the further expected increase in taxation. COVID-19, this pandemic, has brought all of this to light. So if we just take a quick view as to what's been happening over the past 6 months, and this is global as well as what's happening in South Africa. So you first had a panic reaction to this, to the pandemic, which was probably the right reaction because nobody knew what we were dealing with. And we had a global shutdown of all travel, retail, hospitality, manufacturing, as well as supply chain disruption. And a lot of people were furloughed and unemployed. So therefore you had no income for consumers, which meant that there was no demand and no revenue for companies, putting their balance sheets under stress. We then expected a credit crisis, which hasn't really unfolded at this point in time because there's been a lot of quantitative easing, unprecedented quantitative easing, more than 5 times what was done during the 2008 global financial crisis. And this has enabled a lot of companies to continue to meet their interest in debt repayments and whatnot. But unfortunately, there will be a collapse in tax revenue as both corporate earnings vanish and unemployment continues to rise. And we've had this reflationary trade, which is now benefiting particularly the developed world markets, the tech stocks in particular. But we do see a depression globally and in emerging markets, especially in emerging markets, you're not going to have the developed world to sell their product to. And this has led to the rise of fascism as we see it globally. So we do believe that unemployment at this point in time will be worse than the Great Depression. This chart goes back nearly 80 years. As per JP Morgan, and you can see that in the developed world, unemployment is north of 20%. And even though the economies have started opening up, the second wave is now potentially force a bigger lockdown, a longer lockdown, and we could see unemployment structurally above 25%. In the emerging markets, it's going to be as high as 50%. South Africa, the unemployment amongst the youth could be as high as 65%. 2 out of 3 unemployed. So you can see here, as per the South African Reserve Bank and RMB Morgan Stanley's latest research, that there's been quite a decline in corporate EBITDA, corporate earnings, as GDP has continued to contract over the past decade. To take a view as to where we are headed in terms of the South African fiscus. So the position is quite precarious in that we've seen tax revenue basically collapse as capital as well as skills have continued to leave. But at the same time, corporate earnings have been globalized. South African companies have externalized their corporate earnings. So the plights of the poor as well as the flight of the rich have been exacerbated by the fact that there's been no accountability for the corruption that we saw. So there hasn't been any return of investor confidence, particularly on the international side. We've also seen the South African government handle the COVID-19 lockdown. It's been very unreasonable in terms of both its length as well as the restrictions on things like alcohol and tobacco. Given the fact that it's very much only people with high, comorbidity factors or that are, mature or in a senior age group, South Africa's population is relatively young, and therefore the lockdown shouldn't have been as punitive as it has been. So I think the future recovery into the second half of this year will be very challenging. Here's a chart further by Morgan Stanley, basically that the tax revenue has been pulling back, as you can see. And as much as VAT has been increasing, the overall trend for total tax has been on the decrease and has been negative. The good news essentially is that because of the weakness in the rand, we should see the current account deficit narrowing, and the collapse in demand helps that. And at the same time, this should stabilize the rand. The bad is that the South African government is headed towards a debt trap. They cannot continue to borrow and fund large state-owned enterprises, government expenditure, deliver on social grants, and service delivery. As you can see over there, the gross government debt as a percentage of GDP is going to breach 100% at this rate, which is a debt trap. We've seen this problem globally in that there's been a massive amount of quantitative easing, which creates a crowding out effect. It suppresses the term premium, which means investors are forced out of what we call not just risk-free return, but return-free risk. In other words, fixed income products that are offering negative yields into risky assets such as equities, which means that we're continuing to blow this bubble up, particularly in the developed world equity indices. And you're seeing this in the IT, the S&P 500, might as well be the S&P 5 in terms of the tech stocks. But in a debt trap, the other problem is that the borrowing costs, your interest payments, tend to crowd out all your other government expenditure. South African government is the biggest employer in the country and does provide a lot of social benefits. And this is concerning. At the same time, South Africa's foreign ownership of domestic bonds, in other words, foreign confidence and investors willing to take on the currency risk and the risk of default for extremely high yields relative to other, developed worlds, in a world with zero inflation, essentially, has been declining. And this is at a time when the government borrowing is, as Coronation's latest chart shows, is almost off the charts. The backdrop to this is happening at a time when global debt is at an all-time high. So this is probably the biggest bubble I've ever seen. Corporates have taken advantage of extremely low interest rates, very unnaturally low, yield curves to issue debts and re-engineer their balance sheets. Buy back shares, do M&A, pay dividends, but they haven't grown revenue. So they're not growing revenue. They're just cutting costs, which is unsustainable. And you can see the amount of debts. A lot of these big pension funds globally are very underfunded. In fact, I saw today on the news, the Kentucky Pension Fund is suing KKR and Blackstone because of the returns they put them into due to being underfunded, and they've just transferred a lot of wealth from the pension fund to themselves. So there's excessive risk-taking to try and make that up. The final chart I'd say on this issue is this chart, which is quite ugly in that you can see the initial projections from the 2019 budget in terms of debt to GDP or gross government debt. And then you can see the revised budget, and then you can see what has now happened from, due to the amount of debt that needs to be issued to help us, hobble through this crisis, and potentially with the collapse in tax revenue and the continued flight of capital, this could look a lot worse in the years to come. The only saving grace is that everyone is in the same boat. South Africa is probably just the top deck of the Titanic at this point in time. So in conclusion, I think South Africa's social tension is unfortunately rising dangerously. It has one of the highest Gini coefficients in the world, the gap between rich and poor, and the government is not going to be able to continue funding state-owned enterprises and government salaries at the same time without a bailout from the IMF, which comes with all sorts of restrictions, including austerity measures and pulling back on government spending, which will mean social service delivery such as housing, schools, etc., will stall and social grants will get pulled back. It is time to privatize the state-owned enterprises, to privatize the likes of Transnet, SAA, SABC, Eskom, etc. That could take a lot of pressure off government spending and raise some capital for their coffers. I think unemployment is going to stay structurally high for the foreseeable future. It'll take us quite a few years to get back to, normalized unemployment, which is still, 30%. And the youth, unfortunately, have been hit the hardest. It's another lost generation in terms of opportunities. South African companies, many of them had great insights and started diversifying their earnings globally. You saw this during the construction boom, with a lot of the construction companies buying offshore construction companies, which didn't work out that well. But a lot of the retailers did the same thing, the manufacturers. This was on the back of many companies, choosing to dual list when they were given the gap in the early 2000s. So the JSE no longer really reflects the underlying South African economy. It's not really reflective of what's happening. I think the majority of the SA equity market is made up of these global businesses. And in fact, the large cap stocks such as British American Tobacco and Richemont and Naspers with Tencent are kind of, it's almost like the tail wagging the dog. So in my opinion, given the outlook for South Africa, I would stay positioned long global equities via the dual listeds and via just what you can invest offshore. And I would stay short domestic companies, particularly SA Inc. in the form of South African banks, who I believe have absolutely no visibility as to their balance sheets. They cannot have any idea what those assets are worth, whether it's manufacturing, property, plants and equipment, whether it's vehicle and asset financing. I don't think that they are aware of how much risk they're carrying. So I would say short SA banks, SA manufacturing, etc., and long global equity. So I hope this was helpful. Thank you very much for your time, and stay safe out there. If you have any questions, you'd like to get hold of me personally, there's my email address there. Otherwise, we'll chat again soon, and good luck out there. Take care.